All right, everybody. Welcome to today's webinar. We're excited for you all to join us. Today's topic, we're going to go over how to spot a profitable dental practice, before you sign the LOI. We're excited to share some, information and kind of the stuff that, from our experience. Now, before we go into the agenda, I want to just kind of reintroduce us. Omar here with me. He's the CEO and founder of Virgin Consulting. He launched his first business at 16. He's the founder of Virgin Consulting. He's an active real estate investor, and he's part of the Goldman Sachs 10,000 small business and other groups. Myself, I'm the partner for advisory service here at Virgin Consulting. I specialize in tax strategy for scaling dental practices. Lead the tax planning for our large dental operations. We have from 1099s to franchise builders, and all in between. And then, hundreds of dentists have grown tax efficiently, in our advisory services, over the last 6 years. I wanted to go over the agenda before we kind of jump into, our topic points for today. The first thing we're going to talk about is going to be the tax impact of the deal structure. So we'll talk about the APA, the bill of sale, different, various terms on there like goodwill, tangible assets, things like that, and how that impacts you tax-wise and how you'd want to have it structured, for tax purposes. Then we'll kind of go into the hidden cost of strong practices. And so kind of discussing like a practice might look good on paper, right? But what are the things that in between the lines from, the hundreds of practices that we've looked at and kind of give you more insight on that. The next topic will be EBITDA. We'll talk about what exactly that means, how that's calculated, and then things, that are important when looking about buying a practice and how much of EBITDA you should use and what other things you should look at, when buying a practice. Uh, our next topic will be real world red flags from due diligence. Now, we are talking to clients daily that are looking to buy practices. So we're looking at financials, and we have a practice purchase consultation program that we do, where we help clients look at the financials and see if these practices are good deals. And so seeing the red flags there, and kind of talking about that and kind of sharing those that we've seen through our experience, looking at hundreds of practices. Um, we'll go into financing realities. So obviously the different types of things you can do for financing for your practice. Obviously the obvious one is a bank loan, but talking about some other ideas that you could do if that might not be the case. We'll talk about reverse engineering the right purchase price. We'll talk about a formula of how to do that and what exactly that means. And then lastly, talking about entity and ownership structuring. So obviously you buy a practice, you want to be in the right entity and ownership structuring. So we'll talk about that. We'll talk about what exactly that is and what are the potential, pitfalls maybe of doing this the wrong way and how that could affect you severely tax-wise. These are the kind of things that we have on today's agenda. That being said, I wanted to kind of jump into our first topic point, which is the tax impact of the deal structure. So when you buy a practice, you'll have, an APA, which is really an asset purchase agreement, long document, a legal document of all the sale. But something very important on here for tax purposes is the bill of sale. And the bill of sale kind of line by line, breaks down that sale, right? Things that like the equipment and the goodwill. A good example we like to give clients is like, think of like you go to Costco and you buy a bunch of, supplies, things like that, and you get a full itemized receipt line by line of everything you bought and the cost of each item you bought. So think of that as your bill of sale. You might have bought practice 500K, but it breaking down what are the supplies, equipment, right? And then things like goodwill. And so that's very important because that's going to be like the blueprint of your deductions and how we're able, figure out what gets deducted, how fast, and the tax impact. Um, Goodwill versus tangible asset, right? So think of tangible asset as things you can touch. So going back to what I was when I was breaking down the bill of sale, like equipment and supplies, these are things you can touch. Uh, that's what we kind of consider a tangible asset, right? The walls of the practice, right? Your ops, et cetera, et cetera. Think of goodwill as, like things like patient records, right? Non-compete. These things you can't actually touch, right? And so the bill of sale is going to break down your practice into these two components, and why that's valuable and why that's important is how it's tax impact. So with depreciation, oftentimes we'll talk to clients and they'll buy a practice for 600K, 700K, whatever price, and they'll think that they have a 600K deduction. Um, what they don't realize is that, if a good portion of that is towards goodwill, there's slower depreciation lives. And so with the tangible assets, those you get that deduction quicker essentially, right? And so goodwill, that is over 15 years. Whereas tangible assets, you can get that quickly with the bonus depreciation laws and things like that. And so while you might get that 600K deduction, it's just about when you get it, right? And with goodwill, it's a little bit slower. With the tangible assets, it's quicker. And so the tax impact of that deal structure, it's all based on that, that bill of sale and how that sale is broken down. You know, now, Omar, I know you wanted to add a little bit towards the.
Yeah. Are you able to hear me?
Yes.
Okay. I got a new mic, so testing it out. Um, so I like to think of it as going to IKEA, right? And you go to IKEA and you buy something and it comes in a box. There's all these different components to it, right? So same as when you're buying a practice, unless it's a stock sale. Now that's a stock sale is something we see very, very rarely. And stock sales, I'll just glance on it for a second, really is and I'm not gonna talk about too much just because that's very rare. It's typically more in the northern states where it takes forever to set up a LLC, and then you have to the credentialing takes like 6 months or whatever, right? So in those scenarios, they use a stock sale to actually try to move the business over. But a stock sale is imagine that you basically take this cup of water. I've got my cup here, right? And you basically just you're transferred completely to the other person. So it's a full transfer, right? The LLC stays the same, and you're just transferring everything over in one shot, right? Same as you basically buying Tesla stock or Google stock or Facebook stock. The owner of the company changes. So it's ABC Dental was owned by John before, and now John sold 100% of his shares in ABC Dental to Joe, right? And that's it. It's just a transfer over. That's all it is. Of course, from a legal standpoint, there's a lot more liability with that happens with that. And when that happens, you really don't get any write-offs. There's no write-offs. There's no tax benefit. That's all I'm going to say on that topic. If people have questions on that, you can feel free to ask, and I'll jump into it more just because it's so rare. But 90% of transactions are asset purchase sales. That's where you have your APA, you have IKEA model, you buy the box, and the box has different components in it, and those components are going to have different useful lives. The key thing to remember is goodwill versus tangible asset, like Hamza said. Um, and Goodwill is anything that's, it could be patient records, it could be a non-compete. Very rarely is it really going to be like the IP stuff and everything unless you have a franchise, right? But that's kind of how that's typically broken down. But yeah, think of it, you're buying a practice, as you're not really buying the business, you're buying all the components, you're taking all the pieces from the IKEA box, and you're basically you say, okay, I'm buying this, and this, and you're putting all that into your own box. So you're coming to IKEA with the empty box, and you're buying, all the long wooden shelf, the short one, the wheels, all that's coming in the box. You're putting into your own box, and therefore that previous owner's LLC is now empty because you've bought everything out of it. And what he does, he just closes the LLC and moves on. That's why you have a new EIN number, new everything when you come to your new practice. Again, if you have questions on this, throw it in the chat at the end of the conversation. I'll jump into it more in detail.
Now, going to the next slide, Omar, do you want to kind of talk a little bit about the hidden cost, of strong practices?
Yeah, so when you're in the market, you're gonna see different kind of practices. Some you'll see collections and productions are over 1 million, solid cash flow, and then you're gonna see some that are uh, uh, um, it's been the owner's been looking to retire. They haven't really kept up with the practice. Sometimes even the patient records are not even digital. They're still using paper charts, right? But what I kind of tell people is that higher production numbers don't always mean higher profitability, right? We were looking at a practice last week and everything where um, the doctor who's buying it had the opportunity to go, and sit in the office and sit with the doctor and look at the schedule, and like the schedule's full. So excited about this office. Schedule's full, he's booked out, multiple weeks and so forth, so on. But then when we start looking at the P&L, I'm like, okay, well, where's the money? Right? And the collection number wasn't there. So just because production is strong doesn't mean the fact that you have strong profitability. We also have had seen situations where, you could have strong production and collection is whatever, 89, 92%, give or take, right? But then the lease is so heavy, right? And I'll talk about this in the future slides, but the lease is so heavy that's sucking all the profit between the lease and the payroll is sucking all the profit out, right? And so then, but the owner wants to sell the practice based off of collection, right? Because that's his number is high, but he's running a very inefficient practice, so the cash flow in the end is off. So higher production doesn't always mean that. That's why you have to take a step back and look at it from different angles, and it also depends what is your end goal with that practice, right? And I'll touch on that a little bit later. But when you're looking at a practice, you need to look at the patient base. You need to look at the equipment. Okay, what aspects of these equipment am I going to have to go and change, or am I going to have to make the chart digital because they're paper charts? Am I going to have to improve leasehold improvements, right? Because what you're really trying to gauge is the fact that after buying the practice, updating the equipment, updating the technology, updating whatever you have to do in signage and leasehold improvements and making the place look better. What is a true dollar cost do you need to invest between the purchase price and additional investments to get the practice to be its viable? What is that number, right? And that number then based off the income, does that make sense or not? What is the percentage on that? And that's where people typically get tripped up because you have to look at the entire, if you're buying a car, what are all the upgrades you're going to want and have to get to where you want to get to? And that's your total price of the investment, not just the purchase price. Um, but I do know the fact that obviously we're in this market and clients get emotional about buying offices and they sometimes forget about those pieces, right? And what ends up happening is, okay, well, with the additional investments that you made, you just bought golden handcuffs. That's all you did. It's not a business because there's no way you can make it profitable based off all the other stuff that you added on, right? And so between modernizing and renovations. Let's just say the practice is at you're buying it for 600,000 and the collections are whatever 725, right? Sounds like a pretty decent deal. But then if you're talking about digitizing, you're talking about the fact that okay, we need a CBCT, we need these other additional pieces of equipment to get us to where we need to be, right? And the lease is at 8,000 or 9,000 a month, you're never going to cross a 26% EBITDA threshold. And what's going to basically happen is the fact that the practice that you bought is not going to increase in value. And the whole game that you're playing is trying to buy here and sell here, right? By increasing equity. Those are things to kind of really look out for when you see a strong practice, when production is strong, is the money being collected? The second other thing also is to look at in the same case study is the fact that we've seen practices where it's steadily doing 700,000-800,000 in collections, and the buyer's like, hey, I really feel great about this practice because they're consistently bringing in this revenue. And then we start asking detailed questions and say, okay, well, what's the new patient count? Oh, it's great. It's like, 38, 40 new patients a month. Okay. Well, then the marketing should be low. Well, no, marketing is still sitting at $7,000-8,000 a month, maybe even 5,000 a month is still bad, right? Well, then you have leakage, right? So what's the leakage that's happening? Because if you're spending $5,000 to $6,000 a month in marketing, which is about $72,000 a year, your top line should be growing by 12 to 14% a year. That's without adding in any implants. So that's without adding in any higher end procedures. So if I'm getting 40 new patients, my revenue is flat and I'm advertising, well, what's going on? You have having churn. You're in a high level of churn. And that again makes a practice on paper that looks great. When you start asking the questions, it starts to, it's not to look so great. Right. But yeah, I'll kind of throw it back to you, Hamza. on that. And again, if you guys have questions, we can address them at the end of the webinar.
Yeah. And then kind of going over now to like understanding EBITDA. So I'm sure everyone's familiar with this terminology, EBITDA. It gets thrown around a lot, in the dental industry. So first kind of explaining what EBITDA is, this earnings before income tax, depreciation, and amortization. Um, just the acronym for it. Think of it as like a fancy word of saying kind of like what's your true profit after we kind of, take out maybe some of the extra stuff, things that differ from your situation. Um, so EBITDA is important because it's taken out, like I said, depreciation, amortization. That could be higher, lower depending on your practice. Now, as I mentioned earlier, like EBITDA is what's kind of a lot of, we talked to a lot of practice owners and, everyone's always talking about EBITDA and getting their EBITDA up or, when they're trying to buy a practice, looking at the EBITDA. But things that EBITDA might hide, that you want to look more deeper into are going to kind of be things like, for example, owner compensation. You might have a business and the doctor is kind of running a very low salary for themselves. And so their EBITDA might be a little bit higher because they're underpaying themselves. And so profit looks great, EBITDA looks great, and you're kind of like this is a smash on a good deal, right? And so you want to kind of look into that, look at the revenue and what would you actually pay a doctor, right? Based on that revenue, based on the amount of production they're doing. Some non-recurring expenses, these are things that will be discretional by the owner. A good example of that could be like CE, continuing education. Some doctors might spend more, some might be less. So looking into that. And then any other, non-recurring expenses that could be a little bit different that you want to look at, and kind of get a deeper dive of the profit and loss and if there's anything that we need to add back and show true profit, or really there's some minimal expenses that we need to add and account for that might lower your EBITDA and therefore you might not look as profitable or as great of a deal. Things you want to look more deeper into. Omar, do you want to kind of talk a little bit about why you shouldn't base your offer, just on the EBITDA alone from the
Yeah,
cases
so
you've
so
seen?
EBITDA is a term that's thrown around a lot, and I like to really say it should be more based off of a normalized EBITDA, and I'll talk about that in future slides. But remember, it shows a good EBITDA. The sale documents look great because EBITDA looks strong. But when we start looking at, okay, what's driving the EBITDA number, the owner compensation is significantly lowered. Like, unless there's a dentist out there who willing to take 20% of production as a pay, right? That EBITDA is not going to fly, right? So there's a lot of times where we have to start looking and asking questions about, is the owner compensation legit? Is the hygiene legit? Numbers legit, right? Is the non-clinical cost legit? And what I mean by that is the fact that you can have, maybe the dentist's wife is the office manager, right? And but she's getting paid $10 an hour. We've seen it. We've seen it a lot of times, right? So then numbers look really great, but when you buy the practice and you start having to actually hire an office manager, at industry rates, and you start having to do all those different things, and all your EBITDA is gonna drop. So EBITDA is a great starting point, but it's really it's really the first dirty version of the X-ray before you actually start diving in and getting a more cleaner image, right? And we'll kind of talk about it in the next slides.
So kind of moving forward, um, and talk about some real world red flags from due diligence.
Yeah, so one thing we're seeing a lot of is the fact that majority of people that are buying practices that come to us and show us the P&Ls and the financials and everything, they've been done incorrectly, very dirty, very very off. Like it doesn't represent a true business. And the sad part of that is, I did a post on this on LinkedIn and Facebook. But sad part of that about this is the fact that if they had just managed their numbers in a cleaner format, then their practice would be worth a lot more money. So literally, by just having really, really, really bad, cheap bookkeeping, they probably lost about 200 grand worth of practice value, and that's a different topic. But when you start looking at these, especially these practices that are selling nowadays, from transferring generations, misstatements of expenses, misclassified expenses, cash adjustments, Owners discretionary expenses sitting in the P&L, and things that are missing from the P&L, right? We've seen situations where and this comes up pretty often too, where some dentists own multiple offices. Well, they want to sell one office, and the reason for selling they put on the form is the fact that, oh, I want to focus on the other offices. You start looking at the numbers, and you're like, okay, well, how on earth are you running a 700 $800,000 practice that's where lab fees are like, like 6%? 5%. Like what's going on there, right? How are supplies like, 6%? You don't have economies of scale to bring that number down. And so then the question started coming up, okay, well, are we paying for this office's supplies over there from that practice, right? Which are not selling, which I'm not saying is intentional, but again, it's really bad bookkeeping, which you could look at the practice, look at EBITDA and say profit looks strong, but part of the supplies for this practice, part of the lab fees for this practice, part of even the shared costs such as office manager and management, team call center, whatever, hygienist going between offices, right? Is all showing on the other P&L, which you don't see because he's not selling that office, but this office is looking really great because expenses are lower. Now, for example, for us, we're actually in the final stage of building a project where we're because we have hundreds of practices across the nation, we're building a database where we can basically really run cost analysis and see, okay, all the practices, how much this month, what was the average spend on dental labs, what was the average spend on this based off practice size, based off geolocation, right? And so we can look at that and say, okay, well, if everybody's, spending 8% and you're sitting at 4.5%, something about this practice that you're about to buy doesn't seem right, you know and so that's why it's really really important to dig beyond just I love the location, I love the demographics, and I've seen the production looks good, and the EBITDA is somewhat in line, right? But yeah, those are some examples that we've seen, and then I can go on about the different stories that we've came across, but just to kind of get your wheels turning about what could go wrong when you're looking at these practices. um and what as you start digging deeper, what do you really uncover? um Financing reality. So this is another thing. I'll often get on a call with a client buying an office, and they'll be like, well, the bank already approved it, so the bank would have approved if it was in great practice. Well, the bank is strictly going off of DTI, and do you have the ability to pay the loan back, right? You have to kind of take a step back and say, okay, for example, like I go back to the lease thing because it's a big deal. But practices where the lease for the building is 8, 9, $10,000, and the collections is whatever, 700, $800,000. My recommendation is that I don't buy that practice, especially if you're a first time owner, because that lease is just going to go up. And tomorrow, when you need to sell this practice because you want to exit, because you had a family situation, because you had a health situation, because you had things that came up, and you need to move this practice out, you won't be able to sell that practice that has a high lease attached to it, because it brings down the entire profitability of the practice, and that's something you can't control. You can't. That's a piece of the overhead you can't control. And so practices with lower lease structures are a lot more nimble. They're able to basically scale their percentages, and their profitability much quicker. Um, Now, yeah, if you're a seasoned practice owner and you've been there and done that, and you have a game plan like, hey, Omar, I don't know the lease is high, but I've got like 7 ops, and I know the fact that I'm going to basically get this thing to about 1.8 million, in 2.5 years. So I'm going to eat the cost at the beginning, but I'm going to save in real estate space in the future. Instead of having to open 2 offices, I'm going to have one large office where we're going to have, and I'm going to have a rotating, implant person coming through. I'm going to have, rotating, ortho, so forth, so on. And so that's the vision for the office. And okay, but most of the people that are coming to us are this is their first rodeo. This is their first time buying an office. Don't go and jump for things that are like super high in lease costs. And the bank will still approve it because as long as the production and the collection numbers are good and there's enough of a room to pay the note and still pay have a reasonable distribution for you, they're still going to approve it. But you will have a harder time selling it if the collections go down because at least it's gonna is because remember you can adjust wages, you can adjust staffing, you can adjust marketing, you can adjust lab costs and dental supplies by if you're buying with the group purchasing power or whatever, right? The lease, you're stuck. So, anyways, that just in long story short, bank approval doesn't mean it's a winner. It's a good first check in the box, but you have to look a little bit deeper. Um, Creative deal structuring when you don't have bank approval. So there's a lot of practices out there that we're seeing where like I said, the owner's retiring, they're looking to exit, and they were never it was never a $1 million+ office. This was a $300,000 a $400,000 collection office, 4 ops. Sometimes they're in an office building and the owner just like they know they're not going to get much for it, so they're selling it for 250 or whatever, right? And the equipment's all old and you may or may not have digital records. Well, this is where a bank's not going to approve that loan, right? So here's where some creative deal making can happen. You can get equipment loans from the equipment dealers, right? You could go to the bank for a working capital loan, right? And if the deal is structured where, it's asset heavy, or with new equipment that you're purchasing through equipment loans, right? Um, then you're able to take all that as a write-off against your 1099 income because we're going to show a loss on your practice's first year. And the tax that you save, let's just say it's another 50, 70K, the taxes that you save, push that into marketing. So your taxes that you saved paid for marketing. The working capital helped pay to get you off the ground for the first 3 to 6 months, right? And the equipment loan finance the equipment to get started. And you're able to secure a great a startup for a lower than startup cost, right? And now, if you have a game plan on how you can increase the value of this, increase the collection of this practice from 300 to say 800, right? And let's just say that has an EBIT of, I don't know, 200 and some change, right? Well, now you've been able to increase the value of this practice from 2 or 300,000 to 6 to 800,000, right? And you've built an equity. So now you've got two options there. You could basically say, okay, I'm going to go and sell this, pull my equity, cash out the profits, and then go and build my dream office or where I really wanted to be. I just was just kind of I couldn't find anything, so this was my stepping stone, right? But now I've got cash to play with. Or just run that office. You got lower loan payments because you have lower debt to worry about. So those are ways you can play with financing and deal structures and just thought process um, when you get into a situation where the bank's not going to approve the loan or vice versa. Um, that's kind of my 2 cents on that.
And then, when we were doing the agenda, I kind of mentioned about reverse engineering the right purchase price. And Omar, I know you have a way of kind of understanding this and then a formula. So I'll let you kind of
Yeah,
discuss
I
this.
know that if someone is selling their practice through a broker, they normally just look at doctor's discretionary income. I personally think that's just not the right way to look at it because you're starting off your journey not thinking like a business owner, and so the first step into practice ownership, you should be thinking as a business owner. And the thing I always tell, and I know we've got dozens of clients that are on this webinar too, so you probably already heard me say this a million times, but think of this as the fact that if you bought this business and you stuck an associate in there and you went to Hawaii for 4 years and you came back, would there be money in the bank, right? That's a business. If you bought the practice and you have to be there because you can't replace your production pay with another associate being in there at 32%, 33%, it's not a business. It's just holding handcuffs, right? It's all it is. And so when you're looking at a practice, the framework that I always walk through is the fact that if you were gonna if you were going to hire someone to work there, how much would you pay them? And so you back out whatever the owners pay themselves, right? So I just say that you have to, lay out numbers. If you've got a, $800,000 practice or $600,000 practice and the owner pays themselves 100K, back the number out and, from the profit number and then replace it with, if I was going to hire an associate, I would actually pay 200 or 225 based off of production at 33%, assuming the fact that you have 85% is, or 80% is doctor driven, 20% is hygiene, right? The hygiene gets paid through their normal salaries and wages anyways. So how much profit do I have left if I do that? That profit number, should then dictate to you whether this is you have a business or you have a job. And and then that's kind of really, how you reverse engineer it, instead of using just the doctor's discretionary income, which is kind of fictitious because it's you don't have a business, right? You're just basing it off the fact that, yeah, of course you should be making $200,000 or $300,000 discretionary income after buying the practice, of course, because you're a doctor, you're a dentist. But if you put somebody else to work there and you don't make any money after that, you don't have a business, right? And I think we kind of go into that a bit more in future slides. We kind of break down some numbers. So, reverse engineering. So say you're looking at a P&L right now for a practice that you're buying, and the profit shows $200,000, right? Owner discretionary profit, right? And the asking price is $800,000. So if we reduce the profit, and the true doctor compensation by adding in the true doctor compensation. So say the profit is 200,000, and we basically say, okay, no, well, the doctor should be paid 150 in this kind of a production environment. So the true profitability is really 50K. If the new profit number is basically moving from 200,000 to 150, the value they're asking for is 800, but you should basically say this thing is only worth 600, the profit portion of it, right? Now, there's things that come into play, like for example, just say the build out is new or the equipment is new, then you can bump the price up a bit, whatever, right? But if the practice profits are showing 200,000, but after you adjust the compensation, and I think I misspoke, if you adjust the compensation by 50K, not 150, and it brings the profit down to 150, then your asking price should be lower because you're not truly getting $800,000 worth of value. You're getting a $600,000 based of value because you're removing the amount the doctors pay themselves and you're replacing it with the actual amount that you would pay another doctor to work there. And then you're coming up with a new profit number and you're basing the valuation based off this new profit number. And this new profit number is lower. So hopefully that kind of makes sense.
Yeah.
During our practice purchase consultations, we kind of go into more detail and we kind of write down numbers and play with them a bit more. But I just try to do a very high level based on this is a 45-minute webinar. So, but just at least you kind of have an idea of where to start.
Yeah, absolutely. And then I want to kind of switch over to the next slide, which is discussing entity and ownership structuring. So, a common question we get a lot of times with clients is, am I S corp, am I LLC? What is my structure? And so to kind of identify that, first of all, the LLC is the legal structure, and the S corp is the tax structure. So, you want to set yourself up as an LLC, and then the IRS is kind of like, how do you want to tax yourself? Do you want to tax yourself as an S corp, as a partnership? And you could obviously change the way you're taxed. And so ideally, you could eventually be both. Now, it's important for that to be structured at the right time. So in a second, I'll talk about some of the pitfalls we see when, it's either late or wrong structured, but you want to set up that LLC, and then we have the option to, be obviously depending on how many owners you have, whether it's an S corp or a partnership. Now, want to do the S corp, what we typically are doing when we're looking at clients is obviously we want to make that decision by the end of the first year that the practice is open. The reason we want to wait a little bit is we want to see how the numbers look, right? As we've always talked about, you could elect too early, you could elect too late. So we want to look how the numbers look, how the practice is going, but we really want to make the decision by the end of the tax year. Now, Why that's important is if we um, elect that S corp late, as in year two. So this is kind of the common pitfall that I was kind of referring to, is that people are wanting to maybe do their S corp in year two. So year one, they do their own bookkeeping, they do their own stuff. They want to kind of cut costs, so they do everything themselves. They don't file to be an S corp. They take whatever losses, depreciation, etc. Year two, we decided to elect to be an S corp. However, because of that loss and because of us taking deductions, we have more debt than we have cash assets. So you have negative equity. And really, in turn, what that can do is a big major pitfall and cause you to have a big capital gains tax bill. And so it's very important on the timing of that. I kind of have, kind of wanted to show you kind of some numbers here. Like I was saying, like in year one, we take that deduction or we have a loss, etc. And year two comes, and now our assets are about 100K. That's our cash in the bank. But our loans, which is our liability, our practice loan is still 300K. And so we're upside down essentially. We have more debt than we have assets. And so when we flip to be an S corp, we now have a capital gains tax on that difference, that 200K, and that's obviously a major tax bill. And so that's why we want to make that decision at the end of the first year. But we want to also make sure that we're in the right structure at the right timing so we can avoid, this major, tax bill, and just having later headaches down the line.
And this is such a this is a surprise that when we get clients that come to us from other firms or that haven't planned that have not done planning or really haven't really thought about this comes as a huge surprise, and it's really by filing one piece of paper to turn your company from a regular LLC to an S corp structure, disregarded to an S corp structure, uh, you could see a $200,000 phantom income, right? And like comes out like I was explaining, imagine if you look at your company balance sheet, without getting too technical, you bought the practice for 300,000. You wrote off everything the first year, and we're using TurboTax or using whatever that you did, right? And then you then went from having $300,000 of assets to when you wrote everything off, it became zero, right? So now you have the value on the books is zero. I bought the practice for 300, but the value on the books is zero because I took all the deductions. So what is the real assets I have on the balance sheet? I got 100,000 in cash, and I've got $300,000 in loans. And so when you convert to an S corporation, the IRS basically says, okay, I'm gonna go in flip. I'm going to see you as a new taxable entity. And any person, if you basically said, hey, I've got $300,000 that I owe, and but I got 100,000 cash in the bank. Come buy my business. Obviously, it's a $200,000 you're upside down. So if you're upside down, the IRS basically taxes you as that as capital gains. Now, some of the ways that we play around with that in year number one is maybe you have really good contractor income, and we maybe say, okay, let's shift some income from that company into as capital injection into your practice after you buy it, but before December 31st. And we take some of the losses then, and then we flip you over to an S corporation, and then we then bleed out the rest of your deductions in year number two and year number three. So there's smarter ways to do it. Um, the default is not always the fact that, oh, I bought a practice, let me write everything off, and then and be an S corp. That's not the default, as much as online social media says it is. There is a science behind it, the same as when you're doing surgery with a client. There are steps and phases you have to consider, and there are steps and phases you have to consider. If I do this, what will be the repercussion? If I do this, what will be the repercussion? And based off that, like when you come to the patient, you say, hey, here's my conservative treatment plan, right? And here's my here's my aggressive treatment plan. So you kind of what option do you want to go with? I can remove this tooth right now, right? Or we can do a root canal. We can put a crown on it, and we can sit on it for a few years, and you can get some use out of it. But it may start decaying underneath the crown in year number 4 and 5. When that happens, we're going to have to do an extraction, and then we're going to have to put in an implant, right? So if we go this route, this is what will happen. If we go this route, this is what will happen. The same thing is what a good strategist should do. They should be looking at the different dynamics and say, okay, Here's the pathways. And that's why it goes back to what is your future plan? Because if you want to open multiple offices, there's a different game plan to go with versus if you want to buy multiple offices, that's a different plan you want to go with. But if you want to basically have one good office that you scale up to a good amount and then use that to basically invest in real estate, beef up your 401k, reduce your working days, and have more work-life balance. It all depends, right? So the treatment plan depends on what your end goal is and what your risk tolerance is. But that's how it could have serious impacts by filing a selection at the wrong time or buying it in the wrong structure.
Before I go through the key takeaways, everybody feel free to drop your questions. If you have any, and right after we're done with the key takeaways, we'll kind of jump into any questions that anybody has. Um, that being said, just kind of going over a recap of kind of the key takeaways, from today's webinar. The tax impact of the deal structure, right? We were talking about that API, that bill of sale, how important that breakdown is and how that impacts your tax, strategy. We then discussed EBITDA, right? And what exactly that calculation is, but also not to just look at EBITDA, but look at other things and how to get the true profit that we want to look at a practice, whether that's or adding back maybe discretional expenses or adding more expenses, maybe the owner's salary is understated. And so trying to get that true number. And then we talked about, the financing realities. We discussed, the loans and how to go about that and how to have the right structure in terms of everything. So, kind of the big picture framework for evaluating a dental practice deal. Um, that being said, we'll kind of switch over to any questions we have. So
I think I see one in there. You wanna tackle
yeah.
it, and I can jump in.
Yeah, so I'll read that. I'll read it out loud, and then we can kind of go over it. So, we have a question. What if I'm buying a practice with real estate instead of a lease, but the real estate is high because it's in a high value real estate area? The practice makes about 700K, and the bank is worried about making the mortgage payment, so they're lowering the amount financing I need. I have 20% down payment for real estate, but they lowered the amount of the practice. What is your advice?
So, real estate, and we didn't go over this in this webinar. It might be a great webinar for a follow up, just because there's so much information around it. Buying a real estate with the practice is a great opportunity at the right time, because there's specific tax strategies around deducting big chunks of real estate value against your practice. And so, I mean, if you have a good building, you can save a couple $100,000 in taxes. We had a client that had a couple offices. I think his income was over 1.5 million. I think we have the case study on our website. And with the buildings that he bought, we were able to wipe out almost $1 million of his income. And he used that to buy a couple more offices the year after. So there's specific strategies you can use around that, which is really great. In your scenario, you do want to separate the real estate and the practice in your mind. This is common for practice owners to basically jack up the value of the real estate, right? Because they know you want the practice. So if the real estate is high, how high is it? Is it now, when you're saying it's high, are you saying the fact that it's overvalued, meaning the fact that the comps on this real estate, based off the rental rate for a single occupancy, dental practice, and that, zip code in a 1 to 3 mile radius is X, and based off that rent, the building should be worth Y, right? There's a calculation behind that, using your cap rate. But this guy's charging like 100 grand more than that. If that's the issue, then you want to see if you can go back and renegotiate, because you're buying the building at a premium. Um, if you're just saying the fact that the area is a high value area, and I'm concerned about the building being too expensive, um, then you need to quantify the fact that can the area support a higher collection amount. Um, at the end of the day, it's going to basically be about the total deal. So if the practice, let's just say, is really great, you know, then in your mind, if would it make sense for you to pay $100,000 more for this practice via paying more for the real estate because he's overcharging, right? The real estate is fair value, but the total price is high at 1.7 with the practice, or the payments will be high that bank is worried about the practice supporting the total payment. So the real estate is high, but the total price is high because and that's because the building is in a high priced area. How much is how much is the building? So it's in San Diego.
This is 1.1 billion.
1.1 million is a building
Yeah.
of the one, and the total price is
7.
1.7. So the practice is selling for 600,000. So yes, the bank's going to have a concern about that. Um, I mean, I would look to, so you're definitely going to get some real tax benefits, by buying this combination. But the you really have to look at the fact that is a can you increase the value of the practice? Do you feel that there's upside with the practice that's not being taken yet, um, to make up for that? That's gonna be the challenge that you kind of face, because $600,000 practice, 729 collections. The practice is $600,000. You have 729 in collections. So you want to see if you can increase. Do you have upside with increasing the value of the practice by increasing the collections? That's where you're gonna have to really kind of dig into it. And this is probably gonna be a deeper discussion, because you need to look at the EBITDA. We need to look at what's marketing spend, what's the overhead spend. But overall, if the bank is concerned about, this deal, it's going to come back to you to see, okay, what is your confidence level in being able to increase the overall collections? You want to, you want to get the collections to cross close to 950, right? To be able to have that disposable cash flow to basically pay that note down. Um, the building at a 1.1, let's just say, I don't know what the land on that is, but if it's 1.1, and let's just say it's probably looking at about $270,000 write-off. That'll probably, save you about good $90,000 in taxes. I'm just going off really rough numbers. I don't even know what the building looks like, but I'm going off of a 80/20 analysis. That's benefit to you, right? But don't just buy the practice because of the real estate. Buy it because you can take a 729 and move it to, 950, right? Because at the end of the day, you want to be in a situation. Remember, you're always a winner if you can pull the trigger and sell this practice at any time and you make more money, just like real estate, right? I hope that answered your question. But reach out to us through our website, and if you want to do a consultation on a more deeper consultation on that, and we kind of break down numbers more and do like an hour long back and forth. Um,
This next question, Omar, is actually a good question for you doing the practice purchase consultations. It says, can you talk about how to evaluate staff salaries in a practice purchase? For example, some practices in Seattle are paying hygiene $75 to $85 an hour, which I don't see how that's going to be profitable.
Invest staff salaries in a practice purchase. So, um, so you want to look at what's the market area paying, right? If yeah, $75 an hour to $85 an hour, that's crazy high. And it's going to be hard for anyone to make any money on that. Um, but if that's what they're paying, is the rest of the market paying this also, right? And if so, then what does the profitability of the practice look like? Um, because if you don't have the opportunity to make 20 to 25% after paying the doctor and the hygienist, you're back to buying a job, right? And if I don't know the Seattle area specifically, right? But if the pay is so high, I'm assuming that there's a very high shortage of hygienists, which could then affect profitability. And what can also impair you in the future when you lose a hygienist and and you have to pay above market, even more above market to get somebody in. Because that tells me that there's a scarcity in that area. Um, and that's why it also goes down to due to the thought process. It doesn't make sense to even buy in that area, right? Um, I hope that kind of helps answer that question. But you have to think kind of objectively. But
Uh,
look at what other practices in the area are paying. Are they paying that amount or not? And if they are, then I mean, I'm assuming like the fact that you can't really be in network with that kind of labor cost. You know, they doing fee for service and um doing a treatment mix.
gonna wait here a couple seconds, see if any other questions pop up. Um, Feel free, guys, to drop in any questions. Give it like 30 more seconds to see if anything pops up, and then we'll kind of go from there.
But yeah, if anyone has any more detailed questions, if you're looking to purchase a practice, you can visit our website. It's easy to remember. It's dentalcpausa.com. Um, and you can drop in a request through there, and we can help you look at our office. And really, what we do is we do an hour long discussion with myself on the business aspect of the practice, looking at the numbers, looking at questions that you should ask the seller to get more clarity and to see if that matches up with what you're wanting from a office. It is your biggest purchase in your lifetime and the highest opportunity cost. And so that's something we do. We do a practice purchase consult. We typically, do dozens of these a month. And some cool things that we have in the pipeline is, like I said, we're building this database, which should be, complete by quarter four, where we're going to have, be able to track all of our clients. And because we have so many, we work with almost 500 to 600 dentists across the nation. And so we have so much data on how everyone's doing. And we're going to be able to use this with specific benchmarking. And we're also going to be rolling out some other cool programs that I'll kind of announce in 2026 quarter one about how we can help you in your practice journey outside of just accounting and tax planning. So yeah, visit our website, dentalcpausa.com. And if you have questions, want to reach out to us. And thank you for joining today. Hope you guys
Yeah.
have a happy Monday.
No other questions. I don't see any other questions. So thank you everybody for joining us. And excited to have you join us for the next webinar. Take care. Have a great week, everybody.